Hey, security token market. Welcome back to another interview. I'm fortunately enough to be joined here with Nitin, who is a director of financial research and digital assets at IBM. Nitin, thank you so much for joining us.
Hey, Kyle, really great to connect and thanks for having me over.
So I want to dive right into our conversation here today. Could you take a minute and just explain what your role is with IBM and just kind of a little bit of background before we dive into the deeper concepts?
Sure, Kyle. So, in my current role as Director of Financial Sciences and Digital Assets, do work with our existing client base, which is largely financial institutions, capital markets, the capital market infrastructure entities, in terms of helping them understand the next 3, 5, 7 years of the evolution and disruption in financial services industry. And that includes both in terms of the changing landscape from a regulation perspective, but also changing landscape from digitization of the entire financial services industry. So it's been a pretty interesting journey. But prior to my current role, where again, digital asset is a big part of my focus, is also I founded the blockchain labs and digital asset labs in IBM, which has been a pretty interesting 7+ year journey, and happy to chat about that as well.
Fantastic. I mean, I know that IBM has been pretty forward thinking in a lot of deeper technologies between the AI scene and building out Watson and everything they had there, and then certainly with Hyperledger and everything surrounding their blockchain based solutions. It's interesting to hear about your role kind of in the research and development for digital assets, and specifically what we focus on is securities, right? Any kind of
Yeah.
real world asset investment contracts. Where are you seeing the most traction from, and the most interest from the clients you work with and from your division? Is it in the security space, or is it in more of other types of digital
Yeah.
assets?
No. So I think it's a combination of a few things, right, Kyle? I think if you look at the legacy of our company, which is building the financial infrastructure, in fact, the existing infrastructure has a lot of our technology built into it. A few things we have seen. We've seen a massive momentum in payment systems. As you can understand, that United States, where we live, it's a little behind in terms of real-time payments, both in terms of payment infrastructure, but also in terms of payment instrument and stable coins, which sort of were in, came into the system to solve a specific problem of time and trust and be able to speed up the payments to keep up with the true elements of digitization of these securities and various tokens and cryptocurrencies in a marketplace, have suddenly taken a form of payment network and payment technology. So that has been a pretty heavy focus. And with the fourth interpretive letter from OCC, which is last October, which sort of gave a green light to many of the existing banks, but also existing the crypto companies to get into applying for a banking charter, I think it has really catapulted the interest from both the new players, but also from the incumbents. At the same time, we have seen a massive amount of interest from custody providers. So digital asset custody, as you know, becomes the first step in most regulated industries to look into other instruments like ETFs and other sort of lending practices and so on and so forth. So we have seen a massive shift in demand and rise in digital asset custody platforms, which becomes a foundation and a sort of a hallmark of many of the capital market infrastructure to see what's yet to come, both in terms of digital securities, but also in terms of the business model that emanates from things like securities lending and other practices that go with it. So payments, digital asset securities, which leads to starting with custody, and a massive gap around the market data are some of the areas that actually I am, from my vantage point, seeing a massive demand and a lot of thinking, both from enterprise perspective, but also from regulators who are working with these large entities to understand how all of this changes the existing market infrastructure.
That's fascinating. I totally agree in a lot of ways, both in terms of creating these rails, not only for allowing digital assets to thrive, payment networks to thrive, but then also this market data component, which we certainly spend quite a lot of time with security token market, tracking, trading asset prices, understanding the blockchain-based applications of decentralized exchanges and things like that. So let's start it off with Hyperledger, because that's the first thing on my mind. In terms of how that platform works, is that where are you still trying, when you're looking at blockchain based applications, is it all inside of that ecosystem, or are you considering outside blockchains, other solutions, and then what else you can build on top of it?
Yeah, Kyle, I get asked that question quite a bit. And I'll
I'm
tell you
sure.
this, that when we started this journey in 2014, 2015, things were different then, right? You had Bitcoin, Ethereum was still emerging, and we're trying to figure this out. And we said, we serve manufacturing, we serve supply chain, we serve financial institutions. So what can we build as a platform that allows for these consortiums to morph and taking advantage of all the elements that blockchain has to offer, trade, trust, ownership, asset tokenization. And we came up, and I was part of the original team, and we came up with Hyperledger Fabric as sort of a platform for, sort of a consortium-led permissioned network, and hence the whole debate between permissionless, models that have emerged from, ever since. But we also realized after almost 3 or 4 years that the innovation that you see in Ethereum and Solana and Cardano and many of the decentralized permissionless world has been enormous. And today it's $2.3 trillion worth of economic sort of imperatives that are being supported by DeFi and many of the crypto market infrastructures, the liquidity pools, the DEXs of the world. And I think that's a very attractive space. And so while we were looking at Hyperledger Fabric as the de facto platform for many of the permission networks, namely non-financial services industries like supply chain, like trade financing, and so on and so forth, we also began to then look into the permissionless network and figure out as to how can we sort of have one leg in this permission world, which is sort of our domain, and figure out what we can do by selling a platform, which is a software play, and also looking into the decentralized financing space, which has been our focus, I think. So we've been fairly agnostic and open now, though oftentimes we start the journey with Hyperledger Fabric. We spend a lot of time, energy in building the platform and providing legitimacy in terms of pouring a lot of resources, technology, patents, and the whole 9 yards. But I think now we're at a point where we're agnostic, we're fairly open in terms of understanding the evolution and changes that the permissionless world brings to the table, and also embracing that in a true sense.
Interesting. So I love that idea, because that does kind of fit with the whole application of the technology we're building here. Sure. That you need to keep an open mind with how this stuff plays out, and certainly in the security space, right? Because as we talk about with clients and with industry professionals all the time, yeah, with securities, you're really dealing with a centralized cap table and then leveraging some of this technology to improve the benefits of it. But at the end of the day, it is still pretty centralized in the structure. So I think that you have to kind of keep that in mind whenever you're building something in this space.
True. And that's true for regulations too, right, Kyle? I mean, oftentimes when the last infrastructure bill, they were talking about consensus mechanisms. And we've always said that there's no point regulating technology, because technology really knows no bounds, and it will flourish and it will evolve because it solves a problem, right? And oftentimes it's easier to regulate instruments and activities than trying to regulate technology. And I think our advice to working with many of the ecosystem players and regulators is the fact that if you apply the same lens that you've applied since 1933 towards what's a security and what are the derivatives and how do you encompass that into, what happens to all the innovation of new instrument classes that are evolving that are also things of value, things like NFTs and things like adjacencies that many of the industries bring. So it's not fair, in my opinion, to label and classify the entire evolving space into commodities and securities and payment instruments and keep those swim lanes separate. I think we still have to give way to a massive amount of innovation, both in terms of the types of financial innovation, the financial instruments, as well as the business model that are emerging. And they have to have an open mind. I think regulators and technologists both should have an open mind in the space, my opinion.
I think you're totally right. And this is certainly something that I think a lot of industry professionals have been clamoring about for certainly a while. And I think that I heard a great comment made by the CEO of Anchorage at an event here in Miami during Bitcoin 2021. And he made an interesting point around regulators and the fact that from an incentive perspective, their incentives are very misaligned from the innovators, because if they are progressive and forward thinking, they don't receive necessarily any benefit for that, right? They certainly are not economically tied to the success of any of these companies. And they don't really get much reputational benefit in terms of being forward thinking. While if it goes wrong, they tend to be the bearer of the blame and a brunt of it. And so I find that to be kind of an interesting perspective, and one that I didn't necessarily consider. But at least I think for me, the value of security tokens is this opportunity to create flexible investment structures. I mean, you can essentially sell whatever type of security you want wrapped in a tokenization layer, provided you take the right investors, right? So that's, at least we're one half the puzzle, maybe we're starting to try to find a solution to. And that's where the tokenization component, I think, is fascinating. It's just going to be about integrating that with traditional infrastructure that's maybe more of your expertise as well. How does it even happen, right? Like, how do we
Oh, yeah. Yeah, that is something which I kicked off some work a few months back, Kyle. So there are a few things, and let's look at the emergence prior to Bitcoin and blockchain coming into existence. We had all these massive ledgers, and I use the word relay of ledger, batch systems. So if you're moving money or moving an asset from one bank to another bank, there's a whole slew of things that happen in which there's a reconciliation process that happens. There is a web services or EDI component that sends a message, and that's how the assets have been relayed in the digital world. These systems are being evolving for past 20 plus years. It's close to a few $1 trillion worth of investment that has been made, not to mention the business processes, the control mechanisms, the army of people sitting in call centers, so there's a whole infrastructure that supports the way we move assets. Here comes in blockchain, which is trying to completely disrupt the entire mechanism to move from this sort of relayed batch processes that are tying these systems together to one sort of flatten the business process to saying, I'm going to adhere to trade, trust, ownership into a single chain, which allows you to be able to onboard it, onto the chain and be able to transact almost instantly with the same level of trust. And remove the elements of opacity of information that has led to cost, that has led to fraud, that has led to all the bad things that we know about the infrastructure today. And so the question is, for newer companies, the Uniswaps of the world, the Aves of the world, they have no burden of legacy. So it's easy for them to just roll with the new and change the world as we know it. But what happens to the JPMs and the BOAs and the Wells of the world, who have been sort of the hallmark and iconic sort of banking players in the ecosystem, not to mention the custodians and the entire banking system or investment banking system that forms the capital markets. And the biggest challenge for them is not technology. It's not very difficult for them to understand the tech and get on board. The biggest challenge, in my opinion, is cost of integration. It costs more for them to integrate with existing systems so they can still support those call centers and CRM systems and other reporting systems than simply get on the digital asset bandwagon. And I think that's where the traditional finance is at a disadvantage, in my opinion. And then they're doing their best to understand the space. And I think for them, for the longest time, the biggest economic moat has been regulation. And they would like to sort of continue that tradition as they embark on the technical advantages of blockchain. And we'll stop at that, if that makes sense, Kyle.
Yeah, no, I think that's interesting. And I want to dive into that a little bit more. Do you feel that because of that, the traditional financial system is maybe incentivized to maintain the status quo because of that kind of the barrier for them to enter? Do you think that that's going to cause them to naturally apply more friction, or do you think that it will incentivize them to kind of develop their own solutions, which is maybe the other side of it, is to build a walled garden for themselves?
So there are two parts question to that, right? I think I'll start with the fact that anybody who I've worked with, again, the leadership in most of these large corporations who are truly innovative and truly want to change the world and understand the opacity related challenges in the ecosystem and the cost associated with the fragmented sort of financial system that we have at the moment. But there's also this resistance to change, which is an innate human nature. We don't want to change because we've been doing this business for past 100 plus years. The banking system has, went through its own set of changes from paper-based to digitization. So, we have this whole elements of, we dematerialize these assets to digitize it. Suddenly now we are moving from digitization to tokenization. And that is a change. And the first change took a while and we finally got used to it. Next thing you know, they have a new way of change. So the resistance to change, in my opinion, is something that's causing and I would agree with you to an extent that the regulation and the existing systems are an economic moat. So me and you simply cannot get up one day and open a bank of financial services, which is what exactly the blockchain and the various technologies that are trying to do. You have a 15-year-old who can open a desk, just cut and paste the entire code and open his own exchange. Which today in the traditional world, it'll take you at least 4 or 5 years to even get a license from SEC to operate an exchange. So I think you view this as economic moat, and the amount of investment you had with lawyers, the cost structure associated with it. So there's a little bit of that, but I think it's more something basic, which is innate to human nature of resisting change. I think it's more of that than resisting change. The entire change process.
Based on your understanding, we've seen a lot of different quotes thrown around. Paxos, who's doing settlement with Bank of America for some of their securities, have thrown out 3 to 5% in terms of potential savings from a clearing settlement perspective. Figure by Mike Cagney has even thrown out double digits potentially. Do you see that same kind of opportunity? Do you think that that's overvalued, undervalued? How much do you think that this stands to benefit for a lot of those settlement and clearing operations, if properly implemented?
So two things, right? One is if you look at Paxos and Gemini and some of these sort of traditional players, they come from traditional industry. And the biggest advantage that many of like Chris, who founded Paxos, and Novogratz, who's leading Gemini, the biggest advantage they have is they understand both markets. They have earned the trust because they come from that industry and they can speak the language, and they actually fully understand the gravity of some of these things. So I think there's some of that known players, there's some element of trust to say, hey, what you have seen with NYDIG and Fiservs of the world who are trying to create the rails and say, hey, we'll enable any bank to be able to offer you to buy and sell Bitcoins, which was initially led by PayPal, which is also a payment company, as you know.
Mm-hmm.
But I think they're missing the point. I think it's not just about me trying to hold a Bitcoin in my wallet and hold Ethereum and feel good about it and talk in cocktail parties. I think it's more about economic inclusion. It's about, has that changed the cost structure of the way I bank? Has that changed the way we have opened up the ecosystem for unbanked to underbanked? What have you really changed? If all I'm doing is letting you see a Bitcoin in the same wallet that we were able to show a checking and savings account, and you're tied to maybe Bitcoin and Ether when there are 12,800 different asset classes out there, I don't think they do justice to those, but it's a start. I mean, I look at it as the fact that Paxos has taken stable coins and said, if you're able to have stable coins in your wallet, and I can use, whether it's a Paxos network or using relays of centralized exchanges or Silvergate-like models, at least you solve the payment issue, which I'm sure as Americans, we are a little behind than the rest of the world, both in real-time payments, but also like Zelle gives you a limitation of $2,000 a day, and not on weekends, or maybe some parts of it weekends. So if you're a small business owner, that's nothing. I mean, you have to pay your vendors and suppliers, and you have to wait for either writing a good old check or break up a payment into 10 pieces and send them in different form because you only have a certain limit. I think it's very, very limiting for a country whose foundation is built upon small and mid enterprise sort of ecosystem that has supported the country's economy. And if not anything else, Kyle, I think the Paxos and the USDCs and the Tethers of the world can at least solve that problem, right? Solve the issue of payments. And I'll be happy with that. Let's not even talk about DeFi and DEXs. I'm happy that they can solve the payment issue.
You read my mind, honestly, because I was going to go to DeFi to some degree. And really because I think just a really fascinating opportunity to expand upon what we've already established with DeFi is in the collateralized lending space, but for real assets, right? So you look at how popular collateralized lending has been for cryptos and a lot of these tokens that don't have any asset behind them. And one of the main values of using collateralized lending is you get leverage in markets where there may not be established leverage markets, but then also the slippage component, right? If you have a significant chunk of an asset, you don't want to necessarily cause a price crash because you're selling it on the open market. No, instead you're going to get collateral for it to be able to use and still get that liquidity while not necessarily destroying a market that could be relatively illiquid. And I think that that's something that's totally relevant for the security token space. Because when we're talking about early stage companies, when we're talking about exotic assets, you're talking about relatively illiquid markets. Regardless of the vehicle, there's just not as much demand for those assets as there might be for a public market, quarterly reporting asset, right? And so with collateralization, I think it potentially opens up a huge opportunity here for essentially portfolio lines of credit that, if you're somebody that has, only $5,000 or $10,000 worth of stock or worth of an asset, that would never be afforded to an individual for any, rate that,
Yeah.
that is swallowable. Do you see that as something that could potentially be leveraged by portfolios in the future?
So I do, and it's interesting because in I would say very early days of blockchain, I would say 2015, me and my team build this sort of. It's all in public, so there's nothing secret about it. We build a private equity marketplace for the same reasons. It's very illiquid. And if you look at this existing structure of how money is raised in private equity space, it's a 10-year journey. It's, there's a lot of leverage in there. And oftentimes you're stuck for 10-year sort of cycles where you can so there's hardly any secondary market. And the intention there exactly was the whole thing is to bring some liquidity to this whole element, tokenize these traditional PDF files, which became special purpose vehicles in some cases, is to be able to tokenize those things and create secondary markets and fractionalize these things. So suddenly you see two things. One is by fractionalizing a larger asset, you're creating liquidity, both in terms of creating larger markets by inducing affordability, but at the same time, you're creating elements of secondary markets, which in many cases doesn't simply exist. So I learned that lesson in that space. But as I work with entities like yourself and Vitalo and many of the other entities, which is what was discussed in the conference, as you know, is that a large portion of the space, that includes the venture, is sort of completely inaccessible to an average investor. Like you have to really know a lot of complexity. And what tokenization and security tokens do is be able to open that up to the masses, like ability for me to participate in that usually closed economy. And that's something which to me is of tremendous value, that you're not only introducing liquidity in that space where you're opening up this to much larger market share, but you're also able to, by creating secondary markets, allow these entities to be able to liquidate at their will or taking advantage of as the initial investment, which today is, we have seen that with some of the, crypto venture space, and they have taken advantage of this. That, as you know, venture capital, has been there for 10-year lock-in period. Suddenly now investing into a crypto and going after security token raises has cut short that cycle into 3 or 4 years where they can take advantage of that investment, and upon token release, they're able to then use that token in either recouping some of that investment or taking advantage of the upside of the risk they have taken with some of the cool projects that they have invested into. So to me, some of these things are truly changing the way we have done, right? And if you look at the traditional market space, IPOs are expensive, and that has led over time for many of the companies to go private and be private because of the reporting requirements, the cost of regulation, cost of compliance is enormously high, and private equity has sort of taken advantage of that. And in many cases, you will find that the ratio of public companies to private companies have completely reversed from almost 2 decades ago, and that is a sign of where the industry is heading, I think.
Yeah, no, that's very true. I've said on record multiple times that I feel like the crowdfunding industry has so much promise, but the reason why I don't think it's taken off quite the way that maybe some had hoped is because of the fact that the liquidity hasn't changed at all, right? The average retail investor has no interest in locking up their cash for 10 years on a crapshoot, right? Or maybe they do for 1 or 2 businesses. They put a little bit of money in and they pretty much never go back again. And I really, truly feel that investing in crypto very much mirrors that, right? People feel like they're investing early in projects. I think this company is going to be sick, so I'm buying their crypto, when that obviously has no investor protections. It has no actual economic derivative to the underlying company or assets that are being created. Maybe in some cases, governance tokens and things like that have some intrinsic value, but certainly much less, which is why you look at Uniswap, for example. The VCs invested in Uniswap Foundation. They didn't buy the Uniswap LP token. Anybody that tries to tell you differently is fooling themselves, right? So
that's right.
I think that crowdfunding could offer this cool opportunity where companies can, in fact, raise from their customers, raise from the crowd, and then provide liquidity for them within 12 months or even earlier to accredited investors, especially even just here in the US, that it just seems like that really could be a key piece to spurring some of this additional involvement by smaller investors.
But there's something else too, I think, which I think you did talk about, that is 2 things, right? One is, even with Jobs Act, which led to Reg CF and Reg A and Reg D, the limitations, both in terms of what is an accredited, investor, for example, I think some of these things are rather limiting. For example, if you look at Archegos and some of these quote unquote savvy investors per se. They have made some of the biggest mistakes in the world. And so instead of relying upon the wisdom of the masses and relying upon, of course, I think in many cases, investor protection is really, really important, and platforms should do it as a good business practice, alone. But if you look at some of the Reg CF and under Jobs Act, some of them I think are still limiting the ability to raise 5 million or max 20 million. In some cases, I think it's still limiting, given the fact that some of these are born unicorns. You'll find many companies like Dapper Labs have raised 250 million. SoRare has raised 680 million. I don't know if you have access to those. I'm trying to look for an access, and I don't, because it's still confined to some of the VC firms. And I would imagine that if they open that up, then the community itself, the gamers, which is the whole point of blockchain, is to have the community involvement, let the community invest in those projects, which is what we begin to see now with NFTs, because NFT is an interesting beast that's coming up in that space, that's truly engaging community, both in terms of changing the way we have viewed content, the changing the way we have invested for content. And that to me is a hope, I think.
I agree. And I'm super inspired. I had a chance to speak with Samson Mao of Pixelmatic, who's building out Infinite Fleet. I don't know how familiar you are with them, but Infinite Fleet is this multiplayer online game, and they have an in-game currency, which is actually built as a cryptocurrency. They've got each ship and each asset you own in the game is an NFT that you can then either buy or exchange on a market. And they have a security token that you can invest in the game and its revenue as the company and the game sells out and does better. And it's fascinating to see how this metaverse economy begins to get built, where Axie Infinity, right? Axie Infinity is this NFT game where people are making legitimate salaries by playing and building up their armies. It's fascinating to see how all these things begin to get tied together, and which goes back to, I think, your original point of how sometimes securities laws just don't quite fit some of these different pieces, because it's hard to say sometimes. There is this blurry line.
Here's the thing, Kyle, and this is inspiring to me too, because if you think of where we are heading with this, and I'll give you an example of the regulated industry, and the example that you cited is perfect. It's true metaverse, which is interlinking the various digital economic systems and ability for you to traverse with an asset from one to another and be able to have fungibility or exchangeability between those two assets. I think it's purely fascinating. But if you look at where the likes of PayPal and likes some of the payment companies are trying to do. So imagine a world where you have a wallet and you have traditional payment instruments, which is the USD and how we use Venmo and PayPal in a traditional way. They have opened up an ecosystem for Bitcoin and Ether, which is the ability for you to have your wallet and store those in the same wallet. And then potentially in future, you could have central bank digital currency, which is a digital version of your existing fiat. But also what Terra Labs and what Synthetics have done is fractionalizing the traditional securities, which is Apple and Tesla stocks. So imagine I have a 16-year-old and he has a different perspective of how all this should work. And I think I listen to him sometime. I ask him, how would you expect all this thing to work? Because it's that generation that's going to drive this innovation more than our generation will. But his perspective was, look, I have a wallet. I just don't like Tesla stock today. So instead of me going to capital market and sell that, let me just go buy coffee with it, because to me it's $1 worth or $2 worth stock.
Fascinating.
And behind the scenes, you could have a swim lanes mechanism where when you spend that Tesla stock, it is the wallet provider that will handle the complexity to say, yes, this is a capital market transaction versus you spending a US dollar. Which today, as you know, I simply cannot do that because I have an investment banking account and I have a payment account and I have a crypto account, and all are not exactly the same, and I can't use them interchangeably. That is the metaverse which will converge with our existing physics. And that's the world I envision traditional finance heading in that direction, to say, I'll handle all the complexity. You take my wallet. You can keep all kinds of assets in the wallet and use them interchangeably, and I will take care of all the complexity behind the scenes. And I think that is something which, that's a vision that I see traditional finance getting into, while the Axie Infinities of the world are changing the true sense of metaverse.
While I tend to agree, I honestly think you go a step further. And again, I think that it's not a great argument that some of the industry, whether it's crypto or sometimes in security tokens, you get the anarchists that say that the investment banking industry is dying and we're going to ruin it. I think that certainly the power of underwriting is unequivocally something very defensible for these investment banks. That when you're talking about institutional level deals like that, the fact that Morgan Stanley can spin up $1 billion fund that's very defensible. But I do think that even in your example, that's kind of what we've seen from fintech from 2010 to today, which is we're going to innovate the front end and we're going to make it look really fancy and pretty and you're not going to notice anything. But then the back end still has all this 1980s Swift network plumbing where there's actually an investment bank doing all the back end infrastructure, taxes, capital gains accounting, all this kind of stuff. The reality is, at some point, we're going to be able to just smart contract all that stuff out, right? We're going to very much be able to just automate based off the asset class, based off of the time of hold, based off of the means of selling, all these different parameters, establish exactly whether it's a capital gains transaction, a traditional spend, or however you want to do that from an accounting perspective. And that does almost automate out that job wholly. And that's something we're already starting to see, right?
Right. So two things in this, right? So one thing is I do want to discern between automation, which is what smart contracts do really well, and some of the elements of the fiduciary constructs, the risk and the accountability and liability. And then you also have prudential treatment of these assets, which is what many of the existing regulations do, which is oftentimes ignored because we're so hung up on the fee structure that we're paying to banks.
Right.
And I think that is something which is still a challenge in the truly automated world governed by smart contracts and DAOs. And I believe that it's a matter of time and I was listening to a TRM lab presentation this afternoon while I was going for my run, where it talked about OWASP. So if you're familiar with technical world, we have some of the element of how do you protect the infrastructure, and there are guidelines of cybersecurity elements to say you got to do these 15 things, run constant scans, so you can protect your infrastructure. I don't think we have that list yet for the smart contracts in DAO. And as a reason, we see vulnerabilities, we see hacks on a regular basis. And sometimes it's not technical hack, it's just social engineered hack, where you create a smart contract and people bite the bait and next thing you know, they've drained their wallets. And these are still, who do you hold accountable? Because people are still have a bitter experience and are soured by that whole experience. And you still need to protect the end consumer, whether we protect that through protocols, which is the consensus systems and trust systems, or we have a mechanism that as a part of onboarding a smart contract, the protocol itself, the blockchain itself, does some level of inspection, has the entire community agree upon it. Some vehicle that has some level of exactly what Apple does for app stores. When you download something from Apple app stores, you're pretty certain that it has no vulnerabilities, it has no malware, it has no spyware, and so on and so forth. I think we need something of that nature to protect investors. And that's up to us. It's up to me, it's up to you to figure that out. And I think that's a journey that we're in at the moment.
Right. Yeah, no, that's kind of been the interesting part about crypto, especially crypto, because of the fact that there's no, reversibility in these assets. There's certainly no immutability, or there is immutability in the blockchains that causes the permanence of these transactions. It's almost seemed like in DeFi, it's kind of a buyer's beware. That there's a risk associated here, but the benefit there is that, while there's risk, there's also this permissionless aspect. There's this reality that know that you have full control over your asset. Whereas in the traditional financial system, sometimes there's protections, but it's almost like you're bubble wrapped, right? And so we're doing this for your protection means that only 8% of Americans can invest in private companies, or we're doing this for your protection, so you can only sell your GameStop stock on Robinhood because we're not going to let you buy any, or we're doing this for your protection, but it takes 3 to 5 days for an ACH transfer. Yes. And it's like, okay, is this my protection? Or can I just have my own risk and deal with the consequence? So it's kind of this interesting push-pull. I think you're right. There definitely needs to be some sort of net there. But at the same question, it does make you wonder, and whose responsibility is it to back to governance, really, just in general, right? But I mean, our political governance as well as our institutional level governance. How do we decide what's best for the underlying populace? And it's a fascinating conversation.
And the political governance, which we need to have at least 6 hours worth of session for that, is a big problem. I think that I think many of the lawmakers. And I don't want to say because of the age, but because lawmakers have not taken the time to understand this. right? And I think part of the problem is the political governance that is trying to apply the same sort of regulation that we've had for years. And I believe that if you look at some of the progressive economies who have taken the time to understand this, I know ECB or European Central Bank has taken 8 years in publishing paper after paper and looking at the impact of these things. I know Bank of England has done something similar. Whereas I think we are still, I think Jay Powell has asked about the pending report, which was supposed to be last summer, September, and it's going to happen soon, and it's been delayed. So we are a little behind, I think, in that respect, Kyle. But you're absolutely right. There has to be a balance between the ease of use, protecting the consumers, and yes, I think the system. If you look at, I don't know if you read the book Flash Boys, which talks about. So Flash Boys is about this whole technical element that, I have a sub-second advantage over the order coming in. And if you have access to the order book, demand supply,
trades, essentially,
front-running trades, right? Yeah. And that sort of opened up a whole lot of element of the fact that some players in capital market has undue advantage, which actually has now, has manifested into the citadels of the world. But nonetheless, you're right. The system is still rigged regardless of, the cries around investor protection. I think.
Well, I just added Flash Boys to my reading list, so I will definitely check that
out.
Oh,
it's a great stuff. I couldn't keep it down. I finished in two sittings. It was fantastic.
Oh, wow. Fantastic. Cool. Well, Nitin, this has been a fantastic conversation. I don't want to make it too long. Maybe we'll have to book another one to have a deeper conversation, because I feel like we can unpack a whole lot more in a subsequent conversation. But I really appreciate you joining today.
Of course.
It's great to meet you. Unfortunately, I missed you last week or the week before in Austin. In terms of how anyone that's listening would want to connect with you or reach out with some ideas or thoughts, how would they do that?
Yeah, thank you, Kyle. By the way, thank you for having me. I enjoyed this conversation as much as you did, I hope. To me, I only use LinkedIn as social media. I actually have stopped believing in social media in general, but LinkedIn is the only mechanism. But I have now begun to look into things that I value, which is information, truth, and things that I value. So, hopefully someday we'll have a better mechanism to share. But I think LinkedIn is the best way to get in touch with me.
Cool. Great. Well, you'll be able to find his name in the title as well as in the description. You can copy paste if you need to. But thank you so much, Nitin. I really appreciate it.
Of course.
And we'll talk to you soon.
Thanks, Kyle.